This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Good morning and welcome to our second podcast of the year. Thank you very much for taking the time to view this podcast. It is hard to believe, but it is Friday, April 11th, and what a week it's been.
It's been a hectic, long week.
How you holding up, my son?
Oh, you know, couple more gray hairs added to the side here. Keeps you on your toes. It's just absolute craziness.
Yeah.
Like, what is transpiring, obviously, this last week, but obviously over the course of the past month and a bit. It's just been a whirlwind of emotions, to say the least.
Yeah, to say the least. It's crazy. I was looking at it and thinking, back before 2002, they used to call, it was WWF, the World Wrestling Federation. And then in 2002, they changed it to the World Wrestling Entertainment, WWE, stand for entertainment. But I think there's a new acronym now.
What would that be?
WWE, wildest week ever. And for sure, that's going to put gray hair on your head. So,
you can't see it already.
Yeah,
look at
but
that.
It's no.
When I go to get my hair, when I go to get my hair cut, every single time
I see a couple coming in.
The barber's just like, how many more gray hairs are you getting?
Well, if I can give you just a little bit of advice,
let it all gray, buddy.
I know. Well, that's because of COVID.
Yeah.
Lisa LaFlamme. Oh God, do I miss Lisa? Omar Sachedini, you just don't cut it. But Lisa and I LaFlamme, I told you that before. Like, we couldn't get a haircut, and I couldn't put a rinse in my hair during COVID. So go all natural, buddy.
Okay. We'll see. It's just going to be a slow progression.
Definitely works.
And at this rate, it will probably be quicker.
Yeah. So definitely WWE, wildest week ever.
For sure.
I've been managing money for 40 years. We went through the stock market crash in 1987, tech bubble in 2000, financial crisis in 2008, and then we had the COVID, and now we have tariffs. So I'm going to start out, give a few comments here. We're going to keep it shorter than our last podcast. Yeah. Certainly, this has been a tough time to put together charts because I was organized a week ago, but virtually scrapped all of those charts because things change in a nanosecond here. And so what you see here
could be relevant in an hour.
An hour? How about 2 minutes?
Yeah.
So I'm going to start with the update, and as usual, I'm going to turn it over to Cody to talk about our mandates. But this tariff thing is absolutely crazy. I mean, we go from Trump, announcing 104% tariffs on China, then he raises it to 125, then he goes to 145, and Xi Jinping says, well, hey, we can have the retaliatory tariffs as well. So China goes from 84% tariffs on U.S. goods, and then just the other day increases it to 125.
Yeah.
More importantly, yesterday, Xi Jinping urged the European Union to stick together and to resist the bullying, the unilateral bullying that Trump is doing. And he focused on the fact that U.S. and China account for a third of the world's trading volume. Yep. And not only, he said, is it going to hurt their two countries, it's going to hurt the rest of the world.
Yeah.
And I kind of get a kick out of this chart because it does kind of look like the stock market in any given day, especially this part right in here. So, yeah, never seen anything like it. I don't think I will see anything like this again in my career. And Cody, you got a long runway ahead of you, but you might not see this ever again either. So I thought it was important just to maybe briefly go back, and it maybe doesn't seem relevant now, but it's important what we said back in early January in terms of what our outlook was going into 2025. And I'll just whip through these points, but we said valuations are off the charts. We talked about the earnings expectations being too high, that Wall Street is so optimistic on their earnings and their targets for year-end 2025. And you alluded to the fact that we couldn't find one analyst of any major firm that thought the market was going to be in negative territory.
Average upswing was like 11%.
Yeah, crazy. And, we alluded to the fact that, analysts have been dead wrong for, the last several years. They've been wrong for the last 20 years. And what I always like to say, and it's proven time and time again, is the consensus view is usually always wrong. Through the last chart I showed in the presentation last time, I talked about the returns of the third year coming off 2 years of plus 20% returns. And over that period, the next year, there were 5 periods when the market actually was down 24%, and there was only 2 up periods where it was up 14%. So we were obviously very cautious going into 2025. And here's a little something that I said back in January. I want to leave you with one final thought. And I know that my mature clients, like myself, have all heard of Sir John Templeton. When I started in 1985, he was a legend. But now that it's Franklin Templeton, I don't think there's a lot of investors that really know how wise this man is, because everybody wants to talk about Warren Buffett, and we always hear Warren Buffett quotes. We use Warren Buffett quotes. But this quote I find fascinating. Bull markets are born on pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. And if I had to take my best guess after 40 years of managing money, that one final thought is, I think we're in a sense of euphoria. And here's what Cody had to say.
We're not smart enough, even though we have our viewpoints and we think we know. At the end of the day, we could get it wrong.
No question.
Right? And that's where you have to rely on being diversified, sticking to your discipline, having the appropriate asset allocation in place. And when there becomes points where Ken had that really nice quote, very much aligns with what I've shared with you before, is the market is a pendulum that swings from unsustainable optimism to unjustified pessimism. And we both agree that we're in that unsustainable optimism phase. And that's where we implement, as you've seen, our tactical adjustments to start skewing that asset allocation to either more defensive or aggressive.
Yeah, so, we talked about back in January about valuations being, so excessive that if you look on the third column on the right-hand side where it says percentile since 2000, you can see that almost every valuation metrics is like at close to 100%. So we were definitely concerned about the euphoria, the level of valuations that the market was trading at. And sometimes in this business, and I've said it for the last 40 years, is you sometimes get it right for the wrong reasons.
Yeah.
So were we smart enough to figure out the fact that tariffs were going to come in, and one moment they're on, the next they're off? Of course not. But it's nice that we were conservative. We took risk off the table. We rebalanced everybody's portfolios, and our portfolios have held up like the Rock of Gibraltar relative to the market.
Yeah, and I think regardless of it being whatever, as it is with any type of crisis or bear market, nobody really knows what's essentially going to be the straw that breaks the camel's back, per se, right? But it always is times before the inevitable drawdown that there is a sense of euphoria in the market. And it came back to exactly what your quote by Sir John Templeton was, that markets die on euphoria. It coincides exactly what I was saying in terms of Benjamin Graham's market pendulum, where there's unsustainable optimism. And in our minds, we're looking at the behavioral aspect of it. And so I think a large portion, valuations, investor sentiment, just the overall market euphoria, it was looking for something to say,
yeah. And
hey, you need to take a break from this.
Yeah.
And any slight catalyst, whatever that be, the straw that broke the camel's back, took that over-optimism, that euphoria, flipped it on its head, and now we're starting to see, obviously, some more rational behavior because we were extended at the top there, right?
Absolutely. Now, and I think we're in a state of like fear and greed, and like you can't get the catalyst right. Very few people. I mean, maybe Michael Burry in 2008, the big movie, The Big Short, got it right for the financial crisis, but not too many people certainly have guessed this one. And I think it's an appropriate time now to thank each and every one of you for, keeping your wits about you. I feel that, and I don't even use the word panic calls. I had 2 inquiries by phone. I talked to 2 clients. I had 1 email. And, I think after 40 years in this great relationship that we've had, you get it, you understand it, you know that we've been proactive rather than reactive. And it's nice to know that those proactive moves are working out very well for us right now. So, I showed this slide back in January, and we said that the earnings estimates were, definitely far too aggressive. The forecast was for 14% last week. FactSet came out and said that the new estimate for earnings for 2025 is 7%, not 14%.
Yeah, I've seen some other estimates that are a lot lower than that too.
Yeah. So, if
it's a moving target.
Yeah. And if the recession comes, it's definitely going to be challenging. And that's why it's always a moving target with these analyst forecasts. And I don't even know why we listen to these analyst forecasts, because they just get it so deadly wrong. I mean, if we Cody put this chart up last time, take a look, is that they, thought the S&P 500 was going to finish at 48.36, and you go over to the far column here, and they were only wrong by a whopping 24%. Yeah. And over the last 20 years, on an average basis, their estimates have been wrong by 14%. And then we go into 2025, and we can't find one analyst on the street of any major firm that thinks the market is going to end in negative territory in 2025 with a target of 6,683. Now, you take a look at where we're at today, at this second. I mean, before I walked into this recording studio, the S&P 500 was at 5,250. That means the market, to get back to their target, would have to increase by over 22%. You think that's going to happen?
Yeah, no.
Not going to happen. So what are analysts doing? They are tripping over themselves, lowering their estimates. And it's like, okay, false start, you have Monday, manic Monday, market gets tanked. You have crazy Wednesday, right?
Yeah.
And on Wednesday, the analyst going, false start. I'm going back to my original targets. Don't worry. Boom.
Adjusted target.
Adjusted target. And now what do they? And now what do they think after Thursday?
Yeah.
Right. So you can see that they've lowered their targets by 15%, and from 6,644 to 5,641. If I were you, I would not pay 1 ounce of attention of these targets because they truly are meaningless. They're overpaid analysts that get it wrong.
Yeah.
Countless times. So, Cody, what we were talking about yesterday and like Tuesday and Wednesday was the big surge in bond yields, like the 10-year, went up dramatically to over 4.5%. And, the bond market is a leading indicator and not a lagging indicator. And when you have treasuries, and I really believe that was what Trump was concerned about. Trump came out the other day and said, yeah, the likelihood of us putting the U.S. into a recession is high. Mm-hmm. But he wanted to avoid a depression. So that's one of his words. I want to avoid a depression. So it's like when you have Japan and China, which are major, debt holders of U.S. debt, and they're selling, the bond market, definitely was playing havoc. And, we were definitely concerned about that.
Yeah, no, definitely. It's there's a lot of moving parts behind the bond market, and I don't want to get in over our heads today about what
swaps.
those elements are. Obviously, there's a whole bunch of definitely swaps from hedge funds, active managers. There's some obviously bad treasury auctions that are happening, but it just kind of is a very volatile environment and kind of unusual from a historical perspective, in the essence that obviously as you start to see pain substantially from an economic perspective, as if the tariffs were implemented, causing obviously economic pain, usually central banks come out and obviously lower rates. But there's the impression that this will cause another elevated time of essentially inflation with lower growth, aka called stagflation. And hence why, obviously, we've seen between a multitude of different effects. Nobody has the ability to pinpoint exactly what it is, but there has been obviously a jump up in yields. The difference between the jump up in yields versus what happened during the end of 2021 and throughout 2022 is we were at rock bottom rates then.
Yeah.
Completely different story now, right? The hiking from the Federal Reserve perspective on the short end of the curve is behind us. It's just, what's the pain going to be on the 10-year side, and where is this thing going to end up?
I mean, a recession is now probably likely. More people are calling it. Everybody's now talking about stagflation. Could you imagine having Jeremy Powell's job?
Yeah.
Like,
no,
what
we think we get gray hair. Yeah.
Yeah, he's lucky to have any hair.
Exactly. I'm surprised. He has a good head of hair, though.
Yeah, I know, but what do you do if you're Jeremy Powell in this environment?
I don't know.
The answer is probably nothing. There's nothing that he can do.
Yeah.
Because, there's, so much volatility in the market. And, you take a look at where inflation could go, even though inflation was better in February. Yeah. But I've never seen a ride like this. This was Manic Monday, okay? Manic Monday, we saw the index right out of the gate fall 4.5%. Then it gained 9.4%. Then it fell 6.2% and ended the day flat. Like, please, clients, I hope you are not watching this moment to moment. We get paid to watch this moment by moment, and it's shock and awe for us. So please, don't watch the market. Don't go into your accounts. Your accounts are looking better. If you need some comfort, go into your accounts. But this volatility is crazy. This was Monday, April the 7th. And then I thought that was, probably the best case of volatility that I've ever seen. So
crazy.
One moment, tariffs are on, tariffs are off. Truth Social, of course, Trump's media source.
I love it.
Don't you love that?
Love it.
Holy shit. There's a
I'm going to get into that in a second.
Yeah, there's a conspiracy theory here for sure.
It's pretty blatantly obvious in my mind what's...
The market on Wednesday just opens. Mm-hmm. And what does he post? You're going there?
I'm going there.
See, I don't even look at this. Swear, I do not even look at Cody's slides.
You're going to steal what I was talking about in terms of the noise.
He doesn't even.
No.
He doesn't look at my slides, and I don't look at his slides, and that's a true story. So
yeah, that's why we like
is good.
We like to keep the emotional reaction because it's always a surprise that I get to talk about what I don't know about your
so
slides.
I'm sorry if I'm stealing your thunder.
Sorry, I had to cut you off there.
He comes out right after the market opens and says on Truth Social, this is a great buying opportunity, urging investors to buy. Then at exactly 1:18 Eastern time.
Mm-hmm.
Okay?
Yeah. 10:18 Pacific.
Yeah.
Yep.
He takes off the tariffs for a 90-day hold.
Mm-hmm.
The Dow is up 350 points at that point in time.
Mm-hmm.
It surges 2,000. It's hard to believe, but it surges 2,000 points in a few minutes. Go figure.
It's insanity.
So we take a look at the S&P 500. Closes the day Wednesday. Up 9.5%. Its second best year since 2008.
Yep, I have a list. I have a list.
I was stealing your thunder again.
It's all good. We'll go through this podcast quicker. It's all good.
Exactly. We've covered it.
I've covered it.
Yeah,
it's all
we've
good.
covered it. The thing I also found fascinating is they've only been keeping track of volume for the last 18 years.
Mm-hmm.
It was the biggest single day of volume when 30 billion, I did say 30 billion shares traded hands. Wow. And it was the third best day on the S&P post World War II. Then you saw the NASDAQ up slightly over 12%. Mm-hmm. Its best year since, second best year since 2001. Dow was up 8%, best year since 2020. TSX up 5.4%. And then of course, that was Wednesday, and then of course came Thursday, and we're not going to get into Thursday. But the reality is that the tariffs are really having an effect on the consumer, investor confidence, and if investor confidence erodes, consumer spending is going to get affected. People in this environment are going to think twice before they purchase big ticket items, especially vehicles. Used vehicles are going through
the same thing goes for businesses too, right?
Yeah.
And regardless of the whatever happens with the tariffs.
Yeah.
It's that uncertainty and the flip-flop, and I'm going to talk about this in our wealth notes, so clients, please do read it, is that flip-flop and volatility degrades consumer confidence and business confidence. And the business confidence aspect is a big one because stops hiring, stops promotions of obviously integrating new plans. And so they take essentially, businesses don't want to do anything. You don't know the landscape that's in front of you, and thus you hold off. And what does that do for hiring? What does that do for the unemployment rate, right? So there are ripple effects. Even whatever happens with tariffs, if they're taken off tomorrow and then put back on, it's going to have some impacts going forward.
Wouldn't you agree with me that regardless of what happens with the tariffs going forward, that the damage has already been done?
Yeah.
The trust in the U.S.
exactly
has been broken. I mean, you take a look at, the U.S. dollar and its downward pressure. So I really think that the damage has been done, and it's going to be hard to repair, and we're going to be in this type of market, I think, for the foreseeable future. And I think, February's inflation numbers were better and everybody got excited, but the reality here is look at all the things that we buy from China.
Yeah.
TVs, computers, phones, children's toys. That's going to surge, and if inflation surges, who's getting hurt here? Consumers around the world, but all those people that voted for Trump are going to feel it in their pocketbooks, regardless of where his income tax cuts happen because the cost of goods is going to rise dramatically, and I think every consumer around the world is going to feel it in their pocketbook.
Yeah, we'll try making an iPhone in the United States of America.
Yeah. Good luck. And the increase in the price of the iPhones is going to go absolutely through the roof, and they're already at rooftop levels. So I don't know where they go from here, but
take out a mortgage to buy a phone.
Yeah,
you can mortgage.
You can't afford to buy a house.
You know, you can now, which is another crazy thing just in the world of finance, is you can now borrow and split your burrito payments and online delivery payments.
Wow.
And just pay later. So you got to finance your $14 burrito.
Wow.
Yeah. Crazy.
Yeah. Times are getting out. Tough. But we spend the majority of the time talking about the equity markets, the bond markets. There's absolutely no question. I don't possess to be an expert in real estate, but the pain is going to be felt in every sector. And I think you're going to see downward pressure on home prices like we haven't seen in a long time. And isn't it interesting that at the beginning of the year, virtually no one was calling for a recession? Now, Jamie Dimon's saying, a recession is likely. Yeah, a recession is probably likely. So I put up this chart just to say, don't fear a recession. A lot of the damage is already happening. And I think if you go to the market returns of a balanced portfolio of 60-40, and I would say the vast majority of our clients are in a 60-40, 60% equity, 40% bonds, which is a balanced portfolio. You can see that over the last major recessions from 1975 to 2020, that during the recessions, the balanced portfolio held up really well. It was actually perfectly flat. But if you're worried about the onslaught of that, I think inevitable recession coming, I would like you to take a look at the 12-month period afterwards. So we think your portfolios are extremely well positioned. There's no question that we got this call right, Cody, when we said people are going out of the U.S. market, okay, and this is an alarming slide. It shows the biggest drop in U.S. equities ever in history. And where did we say that money was going to go in our first podcast of the year?
Yeah, cash and elsewhere where money's or valuations are cheap.
Yeah,
right? And especially the Eurozone, and that's why we've seen a lot of. It hasn't been immune to the drawdown.
No, it hasn't been immune.
It did have the only saving grace has been the aspect that for the first literally 2 months of 2025, the MSCI EFA, which I'm going to get into the performance, had a stellar go round. And it was that repositioning of obviously people trying to find value, right? Especially with the U.S. markets and what we showed you.
And there was the huge gap between the U.S. equity markets, and the European markets. And we talked about it, reverting back to the mean. Mm-hmm. But, we also talked about the fact that portfolio managers had among the lowest levels of cash in history on their portfolio. Yeah. And again, when everybody goes one way and it's the herd mentality, we at Veris really go hard the other way. And we raised level of cash in almost everybody's portfolios to 10%. And you can see the levels of cash. But the key difference is we had that cash at the beginning of the year.
Yeah, exactly.
Most of the people that have cash now were selling into this turmoil, right? Yeah. And then you have all the so-called gurus, Mr. Lee saying, buy the dip, buy the dip, buy the dip. And what I found fascinating over the last week is that institutional investors have been big sellers when the market's rising, but retail investors have put more money than any other point in history into the market this week and last week when the market's dipping. That's how much faith they put in Donald Trump, if you can believe it.
No, it's craziness what's transpiring.
Yeah. Okay, I'm going to turn it over to you.
Great. Okay, so we just quickly, we're already 30
Well,
minutes in.
I already took,
You already did. So
I
it's good.
already took your presentation.
Mine's going to be pretty
Sorry.
quick. It's all good. So I'm just going to go through a little bit of the market returns. I have my watch on me, which shows me the market, but it could change.
You have it on your watch now.
No, I have S&P 500.
Oh my God, those gray hairs are going to come in.
5,302.
You need to switch your watch.
I know, it's crazy. But either way, wanted to give you the market returns so far for the major indices. This is as of March 25th. I've updated it as of yesterday to show you to show you the change. But we take a look at kind of the performance across the board. As of the quarter end, Toronto Stock Exchange was virtually flat. The S&P 500 was down close 4.5%. Dow Jones down 1%. Obviously, the tech-heavy NASDAQ being hit. The heaviest down 10.42%. Russell, smaller cap companies, obviously a little bit more sensitive to the tariff environment, down 9.79%. MSCI EFA, like I was just explaining, money had to try and find a home. It went out to find cheaper valuation from a company perspective, hence why it was up at the end of the quarter, 6.15. And then bonds, the Canadian bond market did well. It was actually up basically 2%. So mixed bag, to say the least. Obviously happy having the diversified mix. A lot of Canadian equity, trimming back on obviously our U.S. exposures.
Good timing.
And overall, it's been a bumpy ride, because if we fast forward to the returns as of yesterday,
it's not funny, actually.
It's not funny at all, but you can see the things that change, right? So you see TSX now goes from basically flat to down 7%. S&P 500 doubles its loss, down 10%, 10.5% year to date. Dow Jones down 7%. NASDAQ down 15%. Russell down 17%. MSCI basically wiped out all of its gains for the year. It's flat.
But still positive,
right? But that's because of the massive run. And the problem is when you enter events such as these in kind of bear markets or corrections, regardless of what you're holding, the stock market sells off as a whole, globally, right? Yeah. And there may be less in some areas, but still, stocks, regardless of what they are, the techs, even sometimes
everything's intertwined.
Everything's intertwined, right? So that's why the MSCI EFA still slightly up, and then the Canadian bond market kind of losing its steam a little bit, but still flat for the year compared to obviously all the equity indices being down. As Ken alluded to, U.S. Treasuries, a little bit more pressure on the 10-year side. I think, to be honest with you, probably some of that pain is almost gone from that side.
Yeah,
I would say.
And don't think that there's still not a demand for U.S. dollars and U.S. Treasuries. They just had an auction of 30-year U.S. Treasuries the other day, and it was sold out at, I think they raised $22 billion.
Yeah. So either way, it's held the fixed income, as much as obviously the returns are pretty much flat. It's not. The whole purpose is to provide that preservation. And where yields are today, even if we do get the uptick, and we've seen a little bit, we're still confident of its ability to protect capital at this juncture, right? So those are the market returns. I'm not going to go through this. This just shows you the leading contributors of the TSX, the leading detractors. You can pause the screen here if you'd like to go through it, take a peek. But essentially, it's kind of been a flip-flop of what was good in the beginning of, or the end of 2024, and where the leading contributors have now just become the leading detractors, aka Shopify. Down as of the quarter. It's way worse now, but down 10%, right? Yeah. So largest detractor. And it's been also a tough time for some Canadian banks too, right? Banks have Royal Bank specifically. The only bank that's really been positive throughout this realm is TD, but because they got beaten up quite heavily.
Well, they got beaten up for all the money laundering.
All the scandals that happened going on. So either way, that's just a little brief outlook on the TSX. Not going to go through it, but I do like to present, obviously, these slides so you can take a peek. Same thing with the S&P 500. End of 2024, leading contributors have now become mainly the leading detractors. NVIDIA down 19%.
Okay? And we talked about it repeatedly. Over and over.
Apple, Tesla, all essentially the Mag 7 names are on the leading detractors. And what is so funny is Mr. Good old Warren Buffett, the man that raised 30% levels of cash.
Oh, man.
As the billionaire's wealth dissipates rapidly throughout this whole ordeal, Berkshire Hathaway stock up 17%.
He hasn't lost it yet at 97.
No, he has not. Yeah. He has not. But just goes to show you.
I hope he lives to 107, Warren.
Exactly. So S&P 500 there. So just going to go through the mandate returns. This is as of the quarter. I also did one as of yesterday, which is an approximate. It's not exactly to the 10th of a decimal, but it is approximate. So strategic fixed income, basically in line with the benchmark. This was as of March 31st. I think I'm going to skip through this one and just show you the most recent ones.
Yeah, I mean, that's,
it changes dramatically. Yeah. Right? So fixed income still in line with his benchmark. It's flat. Okay, so very strategic fixed income. Have a lot of that, obviously, in our client's portfolio, along with the 7.5% cash buffer as well. Still holding up. It's doing its job, right? And the same thing, too, with...
if we're flat and the market's getting annihilated...
That's all...
We've done our job.
That's all you can ask. And I think the biggest premise being is what we've talked about before is we're long-term investors. We can't necessarily... We're not shorting the market and trying to make a profit in a bear market. We are going to lose money in a bear market. What we try to do, as we have always done, and Ken has outlined over the last 40 years, is protecting you on the downside. Mitigating our downside capture ratios, giving up a whole lot less than the overall market is what we're trying to do.
Because we own great companies at the end of the day. We own great companies at the end. And if we can preserve the capital through our cash weighting, and even though the bonds are flat and we've got like 40% of your wealth... It
provides dry powder.
Dry powder to give us the opportunity to buy. Exactly. But more importantly, our portfolios aren't dropping down to here. So when the market, which we know will always resume its upward trajectory, we're going to start for a much higher level. That's the key.
That's important, right? Because people tend to forget one of the biggest elements, and I say this to a lot of the new clients that we onboard, is the biggest element of compounding. And in my opinion, which kind of throws compounding out, and that's what everybody's chasing, that exponential growth in your asset base. The only way that compounding really, really works is if you eliminate large drawdowns.
Correct.
Okay? And large drawdowns, I think clients don't understand how much this really means. So if you lose 10% of your capital, okay, at the top, it actually takes 11% return from the bottom to get back to parity. You actually need a little bit more to get to where you were. If you lose 50% of your capital, it takes 100% from the bottom to get back to where you were.
Yeah.
That's why for us it's so important to keep our drawdowns as shallow as possible, because essentially doing 10, 11% versus trying to do 100 is two totally different pictures.
Yeah.
Right? And so the road to recovery, the return to compounding becomes easier if you've eliminated those large drawdowns. And that's what the portfolios are designed to do. And on top of it, just give us that cash, fixed income, and the dry powder to buy into beaten equity markets. And I have a very good quote at the end of this that I want to go through that speaks exactly to that. High income, just getting back to this Canadian equity, out of all the essentially equity mandates, it hasn't fared too bad, down 5.83% versus the Toronto Stock Exchange down 6.9%. US focused growth. Tech heavy down 12 versus the Russell 1000 growth down 14. Small cap, Russell's been a very, very tough place with obviously...
Yeah, 2 months later, a month later, it could be back up 20%. But this is very volatile.
If you remember from the podcast, and I wish we brought up another video of that.
Yeah.
You remember how we were talking about holding off in terms of putting more assets into the small cap, finding a buying opportunity.
Yeah. Well, excuse me.
This
Opportunity knocking.
This is essentially what we've been waiting for.
Yeah.
And we have the dry powder to do it, right? So it becomes an opportunity, and there is a lot of fear in that space right now. And that is when, unfortunately, you have to become greedy, right? Yeah. And so it's something that as we essentially take our preserved capital and we start to roll it in, we're not just blanketly buying, and I think this is important for clients to understand.
Very important.
Is we're not blanketly just buying equities in proportion to the overall model. We are stepping in to individual positions and individual mandates that we see value at different points in time. And that, I think, is the key, which speaks to our proactivity, but also our ability to be super tactical with our clients.
Yeah, and sticking to our discipline and our process. And time and time again, it's working. And we said last time there will be opportunities that present themselves.
And the opportunities are starting to appear.
Yeah.
Exactly. And so it's just, the big question becomes, which nobody has the crystal ball, is when.
Yeah.
Right? And that's where Ken and I are working diligently to, obviously, we're not going all in immediately, but you should be aware that probably over the course of the next 2 to 3 months, we will be slowly stepping in to the opportunities that are presented. And it changes daily. That's what you're paying us
daily. It changes every 5 minutes.
So, craziness. International growth, slightly down a little bit compared to the MSCI growth index. And then alternatives, flat.
Well, look at private equity last month. Yeah. I just got the email yesterday. It was up like 2%.
Yeah. So it's
doing its job.
It's doing its job, right? And there's still a large portion of clients' capital to alternatives. And the whole purpose, again, just keep it layman's terms, because there's a whole bunch of other extremely important things beyond just the uncorrelated aspect.
Yeah.
But it provides that uncorrelated rate of return. And it's holding up just like the fixed income does, right? So it's mitigating that drawdown. So the quarterly performance reports are coming out most likely next week. The returns have changed dramatically, as you've seen from the end of the quarter, March 31st to April 10th.
Yeah.
So take it with a grain of salt. Obviously, if you ever want an update, like Ken said, we haven't received many inquiries, but if you feel like you want to pick up the phone and have a conversation, Ken and I are always here to have a call. Okay?
Yeah, I already have gray hair. Call me. He's really busy. He doesn't want any more gray hair at a young age, so call me on my cell. You've got my number. Be happy to walk you through any of our views.
Great. Okay, so I'm going to go through this quite rapidly because you already took it. But the noise, as we obviously call our podcast, Beyond the Noise, we want to take investors kind of through what is all the chaos going on and start to kind of solidify some longer term viewpoints.
His famous chart that he had to hold because of the wind.
It was like a science fair poster board, you know? But the flip-flops, the noise, the news articles, it is absolutely one of the noisiest times I think I have ever seen. And I'm sure definitely ranks up there for you as well, right? So the noise is ridiculous. We don't need to go through it. But there's also a lot of noises. Ken already kind of stole my slides, but this was absolutely crazy. So on April 9th, the market opens, and this is essentially it's a tweet, but Truth Social is a social media platform that essentially Donald Trump got up and running.
Yeah.
Right? And so he had a tweet, essentially, or a Truth Social post, right at market open, at 6:37 in the morning, that said, "This is a great time to buy DJT."
And he didn't call us.
But DJT, if anybody that's not aware, that's essentially Trump's media and technology group. And I just get to show you exactly over the course, right at the beginning of the day, where the price lied. Okay, so tweets that right at market open. And immediately as he tweets that, you can see volume pick up And it goes from essentially $16.81 a share, pops all the way up to basically over 18 in a matter of half an hour. Then,
but his all money's in trust and everything, so it doesn't matter. He's not trying to get richer. So
exactly, and I show that. Then what we have is same day, as you've already mentioned, at 1:18 or 10:18 in the morning, that lengthy Truth Social post comes out where it says, I've authorized a 90-day pause, does a little beat up on China here, and the market goes for its rip.
Insanity.
Absolutely insanity. And this noise is immense because there's a lot of people that are obviously, if you hated Trump before, you're kind of pissed off.
I wonder what the SEC thinks about this.
I know. It's how this is
That's
allowed.
The Security Exchange Commission.
It's crazy. And like
US.
you said, the good thing about paying for so much financial data is we can find just about anything if we like. So here's the ownership of DJT, and you can see all the major shareholders. And obviously, number one, 52% of the outstanding shares for a value of $2.24 billion. Donald J. Trump's revocable trust. Oh, it's crazy. Huh?
I knew this was coming.
You should have just let it be. But either way, you stole my thunder a bit, but it's totally fine. So the noise is immense. And the final thing at the end of the day, he caps it all off by saying, "What a day, but more great days to come."
Oh, of course. Make America great again.
Yeah, so it was a great day, right? And if we stack it based on the largest rates of returns from a percentage standpoint on the S&P 500, dating back to its literally inception, and this is dating back to 1929, is it was tied for 8th in terms of the largest gain ever. You can see 2008, Great Depression.
Yeah.
But what's imperative from this slide, and clients need to understand, is you can see that usually the biggest single daily gains are also coupled with this largest daily losses as well, right? And so they sidestep hand in hand as we get that volatility, right? And so it's a very, very challenging environment as to what kind of happens next, right? And so if we kind of go a little bit beyond the noise, we say, okay, well, what happens after we have a record day as such, right? After a huge update. And this kind of slide goes to show you after kind of some of the largest daily returns, what has been the maximum drawdown over the next 3 months. So after that day, what tends to happen on average over the next 3 months? Historically speaking, after such a large update, we tend to see an average drawdown of another 10%.
Yeah. And the first one is when Lehman went
the first one is Lehman went bust, exactly. 2008, so that's why you see a 25%
Merrill Lynch got
drop.
bought out by the Bank of America.
Yeah, exactly. But on average, I think the moral of the story goes to say, is historically speaking, and if it's any guide, probably is a little bit more pain to come.
It's not over, folks. It's not over.
That being said, the important thing is taking that longer term perspective. 3 months does not dictate our approach. We are long-term investors. And when we take that longer-term view and we say, okay, well, the 3 months is going to happen, we're here to guide us through it and take advantage of opportunities, is if we look out over the next month, 3 months, 6 months, and the most important figure is what is the return over the next 12 months? On average, the return after a single update over the next 12 months has been 28% on the S&P 500.
Yeah, and I mean, you can't manage money by looking in the rear view mirror, but that is extremely comforting, to look at the whole picture. The whole picture. People get fixated just on this.
You always have to take your perspective longer.
Absolutely.
Right? And the only other times where over a 12-month period we've actually seen the market go down further is GFC, tech bubble.
Yeah.
Right? So either way, I think you taking that long-term perspective, and those are only 2 points through a plethora. I think there's got to be over 25 on there.
Yeah.
Right? It shows that being patient is important.
Patient investor always gets rewarded.
And because recession and bear markets are kind of top of mind, I wanted to provide you with a slide in terms of essentially the past bear markets themselves, showing you essentially the time frame and duration it takes to go from the peak to the bottom to the recovery, and the total duration of those events.
Yeah,
So
and just for those of you at home wondering, a bear market, a correction is 10%, and a bear market is negative 20.
Exactly. So peak to bottom, usually it takes around 14 months.
Yeah.
Needless to say, from the perspective that we're in right now, very on the short end of that, right? Mm-hmm. So there's still, from an average perspective, hypothetically, a lot more time that could happen. The only really real one from peak to bottom was
that was the
COVID,
fastest
right?
recovery ever.
Right? And then also Black Monday, 1987, was also relatively quick.
I remember that.
Right? I know.
I had hair just like you back then.
Did you?
Yeah.
That's fantastic.
Yeah.
Fantastic. But just goes to show you that this thing could be long from over, and why patience throughout this period of time is important. So, show this slide multiple times. Not going to go through it, but as we kind of trek through, everything seems more chaotic in the present, right? There are so many events through history to which we always feel like the sky is falling. It's when you take that longer term perspective and you say that this is just another blip of all of the major events that have happened, that it's important that with persistence, patience, and resilience, you're able to get through. So I always use and kind of close out the podcast by talking about Benjamin Graham. I love it so much because it speaks volumes to
you
where
should have that in your office.
I should.
And get rid of your watch.
I should just get that pendulum and just have it there. But it really speaks to our overall kind of philosophy, because it is, in essence, kind of a contrarian viewpoint, right? To where, again, Benjamin Graham being essentially the father of value investing, what taught Warren Buffett everything, wrote The Intelligent Investor, talks about how the market is always a pendulum that swings from unsustainable optimism to unjustified pessimism, right? And we said that we were in this unsustainable optimism phase at the end of 2024, right? But it always doesn't stay there, right? And now we're starting to see, as we see the pendulum revert the opposite direction, there is starting to be blood in the street. There is immense fears going on. And that pendulum has now shifted to one that is verging, in our minds, and could go further. Not peak,
not
peak
yet.
capitulation.
It's going to get there.
But we have unreverted from unsustainable optimism for sure, and are heading into the direction of unjustified pessimism. Are we at that full capitulation yet? Probably not, but it still is presenting an opportunity, right?
This is where all the leveraged ETFs from all the young people that convinced their parents to borrow all of their money, and now they've lost all the borrowed money from their parents. We're just rating about here, so we're getting closer.
Exactly. And so I just want to end on one quote that kind of speaks to Ken always saying the consensus view is always wrong.
I love that.
You love that so much. Very, very contrarian in nature, but there's a very good quote in Benjamin Graham's book, The Intelligent Investor, that goes like this. The intelligent investor realizes that stocks become more risky, not less, as their price rises, and less risky, not more, when their price falls. The intelligent investor dreads a bull market since it makes stocks more costly to buy. And conversely, so as long as you have enough cash on hand to meet your spending needs, you should welcome a bear market since it puts stocks back on sale.
Absolutely.
And so I think that speaks to exactly how we have it positioned. We were the seller of stocks immensely in the beginning of the year and later 2024, taking immense risk off the table. It's honestly, Ken and I talk about it, is very challenging in a bull market when things go up.
Yeah.
But this is where I think the moral of the story is, with the capital we have preserved, as much as we will see some pain in the portfolio, we welcome the pain because it provides us the ability to buy amazing companies at a substantial discount and be greedy when everybody is fearful. And I think that is so, so important for what is going to transpire over the remainder of this year.
Yeah, the volatility is going to be immense, so you're going to have to hang in there. And, there's going to be opportunities. It's ridiculously impossible to try to buy into this market. So we're hanging tight, being very cautious, and we're confident that opportunities are going to present themselves. And, this is where anybody can make money in a bull market.
Yeah,
right.
exactly.
But not everybody can, preserve capital in a down market. And I think that's what we've done a very good job of. So thank you, Cody. And thank all of you for taking the time to listen to our podcast today. And again, feel free to reach out to us at any point in time. We'd be happy to talk to you and address any concerns or questions that you might have.
Awesome. Thank you guys so much.
Thanks, Cody.
Thanks.
Thank you.